really a pleasure to introduce our speaker, Victor Sperandeo. I met Victor a year and a half ago after he heard a member of our Birch staff speak at a gathering of conservatives in either Utah or Idaho, I forget which. In fact, I believe Victor made a speech as well. They got together and had dinner afterwards, and she called and told me how excited it was to meet him. So, finding out he lived in Dallas, we met and got acquainted. Since I've come to respect his business and his free enterprise acumen quite a bit. He's a fan of Ayn Rand and the libertarian movement. He's a very strong constitutionalist. Victor is president and CEO of Alpha Financial Technologies, the founding member of EAM Partners LP, which he also heads up that company. He manages accounts for both enterprises of over $1.6 billion. As noted in the invitation, he is known on Wall Street as Trader Vic. He's widely regarded for his trading expertise and has 3 books on his understanding and experience. Some of you have met him at some of our meetings before, so we're always glad to have him attend. Victor was born in New York, as was his wife, and moved to Dallas in 1994. We're delighted his wife and daughter are with us today, as I already introduced them. His talk is entitled Hyperinflation, a Statistical Inevitability. We will have question and answers at the end. Thanks. Victor Sperandeo.
Thank you, Larry, very much. And I tell you, I heard of John Birch Society in the 60s when I started in Wall Street. I didn't really know much about it. It was new at that time. Well, it started in '58 to my knowledge. But I've come to appreciate very much Larry Waters, knowing we have lunch occasionally, and he's a great man, and I don't say that often, so I really appreciate him and the background, and I will talk a little bit more about John Birch at the end. I'm here as you are. I'm just a member, and I've made this speech since 2010 occasionally, and I'm going to go into how I did that. Spence is going to help me out. As it was stated, we moved the first slide, that the original speech that I made on this was February 16, 2010. I've got some props here. Let me get my prop. What happened is, it's my business, because I do run money, to read a great deal about Wall Street and the government. And this CBO report comes out usually at the end of the month in January or the first week of February. And I read the 2010 edition, which was about 125 pages. It keeps getting bigger, Obamacare-like growth here. It's now up to almost 185 pages. And when I read this, knowing a great deal of economic history of the United States, I'm basically a researcher that takes the research and trades with the information that I've researched. Unlike, it's macro, it's not micro, so I don't analyze stocks and recommend stocks. I do macro analysis on just about everything, especially the global macro economy. Anyway, when I first read this, it was, now of course the administration gives the data to the CBO who calculates it. So really the data that comes into this is driven by the administration. And this is just, the first one was impossible. This one is highly unlikely, and it will never be. Let me just state it that way. So the numbers in here are put forth to fool you and the press, whoever gets a hold of this, who wants to say something. For example, in the next 10 years, there's no recessions accounted for. And we just had 2 in the last 11 odd years, 12 years, let's call it. So they don't really put in any kind of prognosis of reality. They just make up something nice and hopes the press picks it up, and then we'll publish it. The growth rates that they have in here, if you look at history, and we're going to get into that, they're just not going to happen. Impossible. So this is a scam document, and that's what got me to speak about it. When I first spoke, what I was suggesting was that unless we change things, we're going to have this hyperinflation debt, which is a very bad scenario to be involved in, to say the least. I'll show you a little bit about that. But the bottom line is, it is something you don't want to see. And when the Tea Party and the John Birch Society talk about debt, the Tea Party is renowned to have started because of the debt, and it is for a good cause. And the one thing I'm waiting for, Larry, is for Harry Reid to get up in the Senate and start criticizing the John Birch Society as being a poor citizen, because you really make it when he does that. He's so far criticized the Tea Party and the Koch brothers, so you're lagging behind. You gotta get out there and do something to get his attention. Okay, so anyway, here's this updated version that I originally did in 210. I give this about once or twice a year, so it's all updated. Spence has helped me out. Okay, first thing is, now I'm an Austrian school economist. I studied economics in college, and Ludwig von Mises is really one of the great grandfathers of that movement. He basically said economics is a science of the means to be applied for the attainment of ends chosen. Now what that means is there's many ways to skin a cat, and how you move an economy is dependent on how you want to, how you choose. So you can do it with Keynesianism, you can do it with communism, you can do it with laissez-faire capitalism, as the founding fathers did. There are many ways to move forward, and you can do it in these various ways. And all he's pointing out is that is a choice, and I would prefer the laissez-faire capitalism perspective. George Soros, who I did work for a while, I wasn't employed, I was a contracted hitman, if you want to call it that. And this is except his philosophies, of course, are opposite mine, if you know his background. He's a puppet master, socialist, communist. I don't know what he is, but he's not good for the country. But anyway, in making money, he was very good. So he said economic history is a never-ending series of episodes based on falsehoods and lies, not truths, that is extremely unmarked. It represents a path to big profits. The object is to recognize the trend whose premise is false, ride that trend and step off before it is discredited. And that is basically what government does. It makes you think that things are rosy, it's good, we're growing, and things are getting better, hope and change. And then really this is all based on falsehoods, because economic data, now we come to I threw in a little one here. I just wrote this, by the way. This is not this is not put forth in any literature anywhere. And that is, never trust a government statistic without investigating their basis for the computation in modern, for their computation. In modern times, they are always biased towards positive results, and the rules keep changing to ensure that. Right. So when they have a statistic that they don't like, they change it. And this happened with GDP. They just added about 3% growth per year historically, 2% historically to GDP, and they went all the way back to 1929 because they didn't like that it wasn't growing enough. So they added things that weren't in it. They changed the calculation, and they actually put in, this had to do with Hollywood, they put in, instead of expensing Hollywood expenses, they capitalized them, so it added to GDP instead of taking away. I mean, that's just an example. And by the way, anybody that wants this presentation can have it. I'm not here to sell anything. This is just education. I do this research for various reasons for my own business, but I've shared it with you. And all you have to do is contact Larry, and he'll give you my email information. You can email me, call me, do whatever you want. I'll send it to you. You know, no charge, except on the bottom here, you'll see this fine print. We have 2 lawyers working for the firm. And basically what it says, that anything I say here is not necessarily correct. A lawyer thing, go ahead. All right, okay, now I basically come out to this conclusion. Remember, in 210, this wasn't the phrase I used. In 210, I was saying unless you change the direction of debt, you will eventually get to hyperinflation, because hyperinflation comes primarily from too much debt. I'll get into that. But in this case, I say hyperinflation is the future, because now you've got a case where unless a miracle happens and you get a huge Tea Party change in the Senate and the House, and you get a free-loving constitutionalist that becomes president, maybe a Ted Cruz or a Rand Paul type, you're headed in this direction. And unfortunately, I'm going to make the case that within 10 years, it's pretty much going to happen. So hopefully I'm wrong on this, by the way, but I'll let you decide. So you can't confuse hyperinflation with inflation, which most people do. Inflation is something you saw in the 70s. We kind of remember the 70s. Hyperinflation is a run on a bank. It's a loss of confidence in the currency of a country, and thereby you lose confidence and you don't buy the debt. And when you don't buy the debt, the Fed comes out and prints all the money, and basically that's how you get hyperinflation. The best example, the first hyperinflation that occurred, 1920 Germany. Germany lost World War I. It spent a lot of money in the war. It then got fined, if you want to call it that, reparations to the other countries. It couldn't pay. It raised taxes to the point where they threatened people upon death if they didn't pay. They didn't pay. And basically they had to print the money, and that was really the first, in this century, in the 20th century, was the first hyperinflation that occurred. And the only one before that was the French Revolution, which I'll get into. But the problem of this is deficits are unsustainable, and Ben Bernanke said that, but he did nothing about it, or he didn't even mention that the fiscal policy should change. But the base problem is you get lower growth, and therefore this lower growth translates into a recession. See, what you might opposite think, you get it from inflation. Recession causes the debt to rise and the government to print more money. Go ahead. I put in a definition here. I'm not going to read the definition. Inflation is just an increase in goods, increase in money and credit relative to goods and services, which results in higher prices. But hyperinflation was defined by an economist, Phil Kagan, in 1956 in a book that Milton Friedman wrote the preface to. And basically it's defined as an increase in prices, you could use the CPI in this case, of 50% in 1 month. So you have to think about that. Now think about if you had $1 million in the bank and prices increased 50% in a month, you just lost half your money in buying power. Now it's worth $500,000. And by the way, once this occurs, it never comes back. Once it happens, it's over. Currencies don't bounce up like the stock market. So hit the next one there, Spencer. All right, here I give you a little bit of and again, this is a lot of this information I'm going to skim through, and it's for if you're interested in it, you can look through at your leisure. But there's a fellow named Larry Kitlikoff. He's a liberal economist from the University of Boston University, is the way he's structured it. He's a professor, and this is his work. He believes the U.S. is going to go bankrupt, and he and I would horribly differ, because you can't, I mean, we tried letting Lehman fail, and that was the worst thing. The government was so sad it did that. We didn't really mean it. The key is that there's no way that the government lets the U.S. go bankrupt. They will print the money, and I mean, they don't even let Mexico go bankrupt, so they're not going to let the U.S. go bankrupt. But here's just an indication of why this trend is extremely dangerous. In 2006, and this is Larry Kitlikoff's number, which I verified, so it's official number. Gross debt was $8.5 trillion, and In this year, it's 17, when I wrote this, it's 17.3 trillion. It's now 17.4, but it goes up pretty fast. The debt increase was 103.4%. Now, if you look at GDP, which is where the government gets its money roughly, it takes a percentage of GDP and it assumes a certain tax collection on GDP growth. And that number is, in round numbers, 18%. So if GDP is 100, the government figures it's going to collect $180. It could be much lower like it did in 2008, but that's the historical average. So here, GDP growth was 21%, but the debt was 103%. Now that's over this period. So debt is climbing in round numbers at 5 times growth. Now, you don't have to be mathematicians or statisticians to know that you can't grow your debt 5 times what you're earning. And remember that GDP is a percentage. The taxes are collected as a percentage. So let's go to the next slide. Here is a table I threw in just so you could see the historical results of all the hyperinflations rated in history. It's not done by me. The maven here is a guy named Peter Bernholz, who was a professor in Switzerland, who's retired. He wrote a book called Monetary Regimes and Inflation. And his book, by the way, since I've been making this speech, has gone through the roof. I did this in Switzerland one time, and the reporters who were German, they speak German in this part of Switzerland where I spoke, they basically asked if I could interview him. I said, go ahead, and he sent me a little note thanking me for recommending his book. But anyway, here is all the hyperinflations in history. There's another fellow at Cato named Stephen Henke. He would show you more. This is 30 occurrences. He would say there's 53. But what he does, remember the definition is 50% a month. What he does is he counts the same ones twice. If it doesn't make 50 in one month, he says it's over, and then the next month if it goes to 50, he says it starts anew, which is silly, I mean, it basically was a pause. It's not the end of that hyperinflation for that country. The biggest one, which I'll mention, was Hungary in 1946. If you know who Joe DiMaggio was, we all are of that age. And his record of 56 straight games, I say, will never be broken. Hungary's hyperinflation rate will never be broken. In 1946, they hold a record of, and this is now, this is 1 month, 1.295 times 10 to the, I think it's the 16th power, yes. What that translates into is 129 quadrillion, 600 trillion price increase in 1 month. To make it simple, that's prices doubling every 15 hours in 1 month. Yes?
You said Hungary. Did you mean Argentina?
No. Hungary. It's right here.
Oh, I see. Oh, okay, sorry.
Argentina will be on this side. They had, their record was 196, not in the same ballpark. I mean, not in the same game. But anyway, so, and again, this is from Bernholz, so I use his references, and he was a professor and did a lot of this work, so I trusted him. You can go to the next one, Spence. Okay, there's 3 ways you get to hyperinflation. It all has to do really with debt. The first way is if the government spends, the government borrows 40% of what it spends. So it spends $100, it borrows $40. Every single time that's occurred, 100%, remember, you're not dealing with a big sample here. You got hyperinflation in that country. The second way is if the government deficit was 20% in 1 year. Now remember, we had in 2008, we had, or 2009, we had 10%, right? So 20 is high, but every time that's happened, that country's gone into hyperinflation. Now, the other way to look at it, which is really not necessarily 100%, but because there's no number that I'm giving you like these two, but it's the way you look at debt is debt to GDP. Zimbabwe, which is the last country to go into hyperinflation in the last 10 years, last 7 years actually, and it was a 304 debt to GDP ratio, 304% debt to GDP. So debt was $3, GDP was $1. In this case, Japan is 226%. That is really on the block to be the next country to go through hyperinflation. If you look at these ratios as being important, they're a very unusual country in the sense that they are extremely nationalistic, and they're homogeneous. We're a melting pot. They're all Japanese. I mean, they're the ones that created kamikazes. I mean, they are very, very unusual people. So they will buy the debt if the government tells them to buy the debt. They're savers. So that's why they can last this long. Anyway, here's the chart again. This is not for me to continue with talking. It's for your information. Here is the current Kitlikoff number. Larry Kitlikoff, again, he actually is, because he's a liberal, he writes things in the New York Times, publishes them, would never publish anything by me. But he basically says that the unfunded liability is $202 trillion in this country. Now, if you look at other people, for example, in this year 2009, Shadow Stats, which is run by a guy named John Williams, and he said the unfunded liability at that time was 75 billion, and Kitlikoff said it was 115 billion. This is impossible to be accurate, because this is talking about future liabilities discounted to today using an interest rate factor that can be different by, in anybody's mind. But 202 trillion is a big number. Now, to give you an idea though, and this is important, the CBO puts out a GAAP deficit number, GAAP. This is general accepted accounting principles. Every firm, including mine, and we're not a big company, has to use GAAP accounting. The government uses what's called cash accounting. They don't take into account any liabilities. To me, to my understanding, they are the only entity in the world, in the U.S. world, in the nation, that uses cash accounting. It's illegal. If I wanted to do it, I'd go to jail. I'd be defrauding my investors or my partners. So they use GAAP accounting, and once a year, the CBO puts out that number. So the reported number you see was 684 billion was the deficit at the end of fiscal year September. And our leader, our dear leader, has basically said, we have to stop this austerity. And he's using the fact that our deficit at 684 billion divided by GDP is only 4% in round numbers, and he's thinking that's extremely low, and he's done a good thing. Well, if you use GAAP accounting, it's 6.2 trillion deficit, and that's the government number. That's the CBO number. 6.2 trillion is 10 times the stated number. That's why I said you can't believe anything the government tells you statistically unless you look into why are they saying this, how does they calculate it, etc. Now, I don't expect you to do that on every number. I'm only saying that if you make decisions based on government numbers, I have a bridge to sell you, if I have to put it in the old-fashioned way. So anyway, now here are the new numbers. The key is that 202 trillion that Kitlikoff, he's the high, and it's probably somewhere a little lower than that, but it doesn't matter. It's ridiculous. Go to the next slide. Okay, this is just a simple chart. I couldn't get it beyond, this is a government chart, and they didn't update it. Again, once you start to get these hockey stick movements up, these exponential moves they're called, right? Up. Usually you're on the road to the end. I mean, you can't keep doing this kind of, if you will, hockey stick picture and continue. It has to stop. When it stops is another question. And by the way, the problem with predicting things like this, and this is not a prediction, I do say in the next 10 years, but you can't really predict it because it's predicting when people will lose confidence in dollars and debt. That's a very difficult psychological thing in mass psychology to predict. How do you predict such a thing timing-wise? You can't. So this, though, gives you a picture. This is the U.S. debt as a fraction of GDP. This is the debt in trillions. And by the way, this is this doesn't take into account off-budget debt. That's another debt item. This is what's called, there's two debts. There's what the government puts out and is spewed throughout this is what's called public debt. That's the debt in the hands of the public. They don't count Social Security debt or many other debts. And then there's the debt like Fannie Mae and Freddie Mac, which is about $9 trillion, that is off budget. So they spend money off budget. It's not in these budget numbers. It's not in here. But the government collects the interest that Fannie Mae gives it, and it says it's a reduction of the deficit. But when they spend the money, somehow it's not counted as spending. You see a little bit of the trickery that goes on, and anybody else would go to jail. But anyway, here we go. Next one. Okay. You know, to grasp what a trillion is, I'm going to let my daughter see this. To grasp what a $1 trillion is really unfathomable. Assuming that you can grasp, we have 17 trillion in debt plus, and off balance sheet, and another 10 trillion. That's not counted. Social Security, other things, Fannie Mae, Amtrak, there's a whole bunch of post office. Anything he says is off budget. Well, here is a picture. If you took a $1,000 bill and you piled it upon one another until you got to $1 trillion, a stack of $1,000 bills, which, by the way, they stopped printing somewhere in the 1930s in my recollection, you'd have a stack as high as 67.9 miles high. You'd actually now be harming, you'd be creating global warming because you would be making a hole through the ozone layer, because that's where the ozone layer is. It's about 68 miles high. So the key here is that if you can imagine 17 of these, it doesn't go to the moon yet, but it's getting close, and it is an incredible number that cannot be paid back. So you have to bear in mind that none of this debt is expected to ever be paid back. Can't be. On to the next chart. Here is just a number you'd like to see, which the spread here is the difference between what the government collects and what it spends, and it just gives you a picture that it never comes together, ever. Now, in the days of the late 90s, there was a balanced budget, and that's why these numbers crossed here, and that was an accident. That's because of technology through the internet. It created a lot of short-term traders that made a lot of money trading stocks at that time. And so they accidentally balanced the budget. It wasn't planned for the way they thought. But anyway, this is, again, in case you want to look at the differentials and the trends of those differentials. Now, this is an important chart, and it tells you why the middle class is suffering. And I will make this case from 1913, when we created the Federal Reserve Board, until 1971, when we officially went off all gold standards, meaning the domestic one and the international one, the increase in the CPI was 2.4% compounded. Not horrible, not good, 2.4%. When we went off the gold standard totally, all fiat money, it went to 4.26% from 1971 till January of this year. That's the compounded rate. So if you can find me a person that works for a living on a wage basis and is earning 4.26% net of taxes, remember that as you make more money, you go into higher brackets, you pay more taxes on the same money that you should have not been taxed on in the first place. The point is, you can't overcome 4.26% a year in raises every year. There's no shot. And with the alternative minimum tax and many of the taxes that get piled on, you're talking about really something like you have to make 7% a year for 43 years to keep up, and you can't. So that's why if you've heard of middle class lagging behind, they never mention it's due to the Fed, ever. But if you raise, if you will, the printing of money and prices to that extent, and these are the government reported numbers. Remember, you don't want to trust these numbers. This is low because they keep changing the calculations. But just to give you an idea, the trend from 1913 to 1971, it has a 10-degree slope. And then after we went off the gold standard internationally, Nixon's contribution to American history, the slope is now 50%, 50 degrees, I should say. So here are some various compounded rates. This is a particularly important chart for me. And let me give you why you can't base even this 4.26 as being correct. The Bureau of Labor Statistics puts this out. And in August of 2008, the monthly labor review, which is kind of like the New American, it comes out. There was an article called Common Misconceptions about the CPI. And here's what they say, here's how now they calculate the CPI. It's been changed 4 times since 1980. It always is made the number lower. It's manufactured to be lower. The CPI's objective is to calculate the change in the amount of consumers need to spend to maintain a constant level of satisfaction. Now, my daughter will attest that my needs are much higher than her needs. Because I had to pay for a college and things like that. So they were higher needs, but the point is that how do you calculate an index that's supposed to measure a basket of commodities? And the government says, well, wait, we're really not calculating the price increase. We're going to calculate this based on what makes you satisfied. And you satisfied is 317 million people. See how absurd it is? Where are the people with pitchforks in front of Washington? I mean, that is the most incredible statement I've ever read from a government, because it's basically saying, look, this has no meaning except what we say it is. Okay, next chart. All right, now we're going to get into too many numbers for me to speak on. I'm just going to go over roughly some of these. If you want to see what the government predicted, the CBO predicted, versus what they were, you can go through here. Here are some historical compounded rates of return for the people who care about this. I'm going to skip this because I have more important numbers in the back that are more relevant, but I was giving you a history in case you want to see this. And I've given this to a couple of CEO boards, and they want to know this, so I put it in. Now, if you're an economist or you studied economics in school, like I said, I'm an Austrian school economist. Most liberals are Keynesians because Keynes basically said if you spend more money, the economy will grow. Now, here is living proof that this is false. It's scientifically false, not I think it's false. Basically what this is GDP, not adjusted for inflation, since 1903 when they started calculating the numbers. And this is spending, and this is GDP growth. Now, by the way, in 1903, the government, state, city, local, and federal, spent 3% of GDP. Now, it's in the 40s. So you can see how government has grown with the help of Keynes. But the more important factor is, as government spends more money, you can see the trend, you get lower growth. I can get into detail on that, but I'll leave it for the questions. But it proves, if I were the Wall Street Journal editorial, this is really all you have to show. You don't have to say anything else. Government spending lowers growth. That's right. And that harms the country and the standard of living of all its inhabitants. Okay, next chart. Here is the one chart that I wanted to point out where in 2009, the U.S. government borrowed 40%. Now again, because it forced with zero interest rates, which are now going on 6 years, it did help lower the deficit temporarily. But this 40% number is, remember I said that once you get 40, when the government borrows 40% of what it spends, every country's gotten hyperinflation, doesn't mean the next year. It shows you the core fundamentals are deteriorating to such a degree that what will happen is in the next recession, the number will be down here, and that's when you'll get, in my view, the potential. And I don't predict this religiously in the sense that I know it's going to happen, but that's when I believe you'll start to see hyperinflation. Okay, so I just wanted to show that. Now, this I used to show was the 30-year potential problems of the country. That's now 10 years. So I'm going to leave this here for you to look at, but this is a no hope. That's why I said there is no hope. 30 years is impossible if you look at these numbers, but let's go to 10 years, which is more relevant. Hit the next one. And by the way, this is independent. This is the OECD, the Organization of Economic Development. This is an international government country. Okay, this is similar to the CBO. And basically, here's what they show if things don't change. The debt to GDP ratios of many different countries, Germany, France, you name it, Greece. And they go from where they are now, which is really 107, 100 to 1, 75 to 1, to 400 to 1, 300 to 1. The US is in here somewhere. It goes to, let's call it 420 to 1 debt to GDP. Impossible. See, you'll never see that. That's why I say 30-year projections are passé now. So it's like saying I'm going to live to 150, maybe. There's no shot. Right? Okay, now we saw the debt to Japan. It was 226 when I calculated at that time. So 226% debt to GDP. And you say, well, how does Japan fund this debt? I don't think anybody here, I'm going to guess, doesn't speak Japanese, right? If you don't speak Japanese, I'm going to interpret this for you. This is a government ad. And these little girls here, these cutesy girls, they basically say, we like men who own Japanese bonds. That's what it says. If you can read Japanese, you can verify this. I actually almost bought some bonds after seeing this. And that is exactly what it says. So they, you know, when we were in World War II, they said buy U.S. bonds. Okay, that was for the country to, you know, save itself. This is for Japan to keep doing what it's doing, and it uses these attractive women to sell men to buy bonds. Okay. Now, here is what hyperinflation looks like. The first hyperinflation was the French Revolution. And it's the only one that occurred before 1900. And it was the only one that occurred on a bimetallic standard, meaning gold and silver was the money of the day. This had other things involved, but one of the co-founders of Cornell University, a very respectable university, a fellow named Dickerson White, Andrew Dickerson White, he did the research on this and basically went back and calculated the prices of things and did the research to show what happened in this period, which was, by the way, 1790 to roughly 1795. When you get these events, you create dictators. Yeah. French Revolution, you got Napoleon. In Russia, in Germany, you got Pip. They usually, because they wipe out most people. Here are some of the increases in prices. A bushel of flour went from 40 cents to $45. So it went up 115 times, not percent. Don't confuse this column when you get this. By the way, you can download this book. It's called Fiat Money Inflation in France, and it basically is free because this was done in 1914. Obviously, the copyright is gone. It's 60-odd pages. If you want to get a feel, and it'll look very familiar to what we're doing today, of what France did. And this was where Marie Antoinette lost her head. There was they couldn't buy food, so she said, let them eat cake. They couldn't buy bread, is the phrase, so that cost her head. Now, someone asked me about gold in here. How do I hedge myself? Well, gold went up 288 times. So if you get hyperinflation, all you really need to hedge your net worth is 5%. 5%. Gold today was around $13.50 when I left. That would mean gold is going to be $388,000 an ounce in these terms. So if you want to hedge your net worth, but you should only buy gold minted U.S. coins. I don't want to get in. You can go to the question, which I'm going to get to in a second. But this gives you a picture of what happens in hyperinflation. It gives you a feel, which is in part what I'm trying to explain here is what you should be worried about. Although I hope I'm wrong. I always say that. Keep going. Expensive. All right. Now we get into some modern times about these numbers, and these are 10-year projections. So there's CBO projections and there's historical projections. So let's just say that if you have nominal GDP growth of 4.5, you've got to take away roughly 2% inflation. In 10 years, GDP, which is now 16.6 trillion, will be 24.0 trillion, with a tax rate which is historical, which is the 18%. Here it is, 17.9 is the exact number. The government's going to collect 4.3 trillion. So assuming a growth rate of 4.5, less inflation, the government's in 10 years going to collect 4.3%, 4.3 trillion. Now you come to the spending side. Here's spending. Spending from 1999 to 2012 was 6.4%. I'm not going to bore you with too many of these numbers, but just to make the case, your spending number is going to get you debt to 27.2 trillion in 10 years. Now you have to ask yourself, what's the interest rate likelihood in 10 years? The historical rate, average, meaning you take 30-year T-bonds and 30-day T-bills, the average is 6.2%. That's the interest rate that's normal. That comes from 1961. So 54 years worth of interest rates. These are unusual times. If you go to 6.2, then you can take 6.2 of 27 trillion, and you've got a calculation of interest alone being somewhere in the area of 1.9 trillion. Now, the amount of taxes they're collecting is 4.3. You see, how does that work? It doesn't work. They can't, once you start to print interest, then the people run from the currency. See, they're now just printing new money. And of course, the old money, the principal that has been accumulated. All right, I leave this to you. If you have any questions, you call me because I don't want to bore you. We have one or two more of these tables, but I'm going to, I think these numbers speak for themselves. Did you hit them? One more time? Oh, here we go. Okay. Well, this is off balance sheet stuff. You can see where I say it's 27 trillion. It gives you some growth rates here and some spending. Let me just give you one spending number. 1978, I pick it at random. You can pick any year you want. To the end of last year, fiscal year 2013, debt increased let me get my numbers right here, 9.2% compounded. From 1978, or you can take 79, you can take 77, you can take any period you want. Debt is increasing at 9% a year historically. Growth is 2.3 according to the government calculations. Remember, the taxes are a percentage of that growth. You see how this doesn't work in the long run? And the Tea Party is right. They don't know all of this. It's intuitive. You can't keep doing what the government's doing. And yet, the Democrats don't care. So you have to ask yourself, well, are they stupid? They're not stupid. They know. All right. Next. All right. These are, again, I'm not going to bore you with too many numbers. These are for your inspection if you want, but it basically makes the case of what I just said. The deficit in 10 years, according to this assumption, you're going to get a $2.6 trillion debt. Remember, I was just talking about interest. You're going to get, this is impossible to maintain, and that's where this hyperinflation scenario comes from. because you have to print to pay this. Okay, there's one last chart here, one last picture. Now, this was the executive order by FDR on May the 1st that basically went into the Constitution and took the U.S. off the gold standard. So that allows what we see happen here. Now, it basically gave you 3 weeks to turn in your gold. Otherwise, you get a fine that's equivalent today of $250,000, and you could go in jail for 1 ounce of gold, 10 years in jail, which basically, by the way, was the minimum for bank robbery. If you robbed the bank, you got 10 years. If you didn't turn in your gold, you can get 10 years. So, but the amazing thing about this, and this is well known, is not he signed an executive order. It's that the Supreme Court wouldn't hear the litigation. Of course, the government was sued. There were 4 lawsuits. And the U.S. Supreme Court wouldn't hear the case. So the problem really is a conglomeration of government that is not for the people, they're for themselves, you see? So you can't trust the Supreme Court, just like John Roberts with the Obamacare passing, change the laws and rules around to make it a tax instead of a fee. This, to me, is mind-boggling because it says clearly in Article 1, Section 8, that gold is money. So here, they just took the money away. They said, give us your money. And the Supreme Court wouldn't hear that as unconstitutional. All right, next one if you want to go, and then I'll ask questions. I think that's it. I'll see it. All right, so now we got 5, how long do we have, Larry?
Like 10 or 15 minutes.
Okay, so now, yes, sir.
Yeah, so I read the European Central Bank papers, and they keep admitting that they have a serious debt problem, although I guess publicly they wouldn't say that. And they talk about mobilizing cash on the sidelines, and they're talking about capital levies. And I'm wondering how long before America looks like Cyprus.
Well, again,
I guess my fear is they use the debt as a further excuse to rob us. Is what
I'm going to repeat a little bit of this. Right now, the system keeps working every day. You don't see people with guns in the street. It keeps working. So when you predict that people will stop accepting dollars in general, and when they won't buy bonds, and when China should sell its bonds, even though it's to its detriment in the short run, I mean, you can't predict that. So because it's mass, you're predicting mass psychology. Very difficult to predict. And it's a guess, so I can't answer you. I can only say that someday, within 10 years is my call, it'll happen. Yes, ma'am.
I was wondering, I've heard that recently the Fed is planning to get rid of cash as coins and so forth as means of exchange and put it all, I guess, electronically. I don't know, but that you won't be able to spend dimes and quarters and dollars at the grocery store.
Monopoly money, I'm not disagreeing with you. I haven't seen that. I pretty much read everything I can about what the Fed is doing. I'm not saying that's untrue. I don't really think it matters. I think what matters is the amount of money the Fed and the government are creating, although that seems unlikely. That's why I recommend owning gold coins.
Do you think they'll confiscate the coins again?
It's possible. It's possible. I don't think people would turn them in to the extent they would before, but it's very possible. You have to take that into account. And I'll give you an answer. Spencer, go ahead, ask me a question. I'll give you what I recommend. Yes.
On lead. But do you think Obama knows that the wheels are coming off, judging by the State of the Union address where he said that they're going to now force savings accounts onto us with government-issued bonds?
Well, I think he knows there's a debt problem that has to be solved, and he was using his way of doing things to potentially lessen the burden But $15,000 IRA forced accounts are not going to save anything, right? I mean, you see these numbers. I mean, they're not going to save anything. So I think he was just trying to cater to some base of his that thought that this was a good idea. Yes.
If one owns common stock, and that is bricks and mortar, in various well-established companies, would this be one way of surviving a collapse?
Here's what, not mark to market, okay, but they do come back. Stocks come back. So in the French Revolution, stocks went, all these hyperinflation stocks go down. Germany, some of the companies that exist today existed in 1920. So they go down and then they come back up. So when you get hyperinflation, business stops. Things don't occur the same. You've got to pay people every couple of hours, so they go out and buy things. It becomes irrational. And I'll tell you what I did. I interviewed a family office in Brazil. Brazil had 2,000% inflation in 1 year. Hyperinflation, they get counted. And I asked them what they did because they've been around. They were around in the early 1990s. It occurred in 1993 with the 2,000%. And they basically said we sent, now this is a very wealthy family in Brazil. They sent people to food stores like Albertsons when they opened. And they'd go down the aisle and they'd mark off all the prices. And then they'd send them back at noon and they go mark down the prices. And that basically was telling them what the real inflation rate, at least the government was lying to them. Now in Brazil, by the way, the government doesn't calculate inflation. It's 3 universities have a formula, and they try to stop the process that we're in. But let me give you the idea that I think makes sense to you. A bottle of Coke in 1993, and I'm making this up because I don't know what a Coke costs, but let's say a Coca-Cola costs $1. But let's say next week it costs $30. What would be the tendency of everybody in the room to do? Not buy the Coke, right? You say, I'm going to boil some water, or if you have a boiler, I'll get some water and I'll drink water because for $30. I don't know what the value is. See, that's the problem in hyperinflation. Business stops because you don't know what the value of anything means or is. So you don't buy anything. You can't get credit, can't buy a house, can't sell your house unless you need the money and you sell it for a ridiculous amount to somebody. So business comes to a halt, and that is the issue. So stocks go down, but then when things change and there is a reversion of the currency, they usually make a new one, then stocks come back up. That's what happens. Yes?
What about silver?
Same thing. Gold and silver are the same thing. I mean, they both will hedge you. I don't have the numbers for silver in 1990 and 95, but it would be the same thing. Anything that's precious would have that effect because the paper you just printed, right? Now, for the lady there, what's your name, ma'am?
Millie.
Millie. Okay. The government can do anything it wants, so it certainly can confiscate the gold. I wouldn't buy GLDs or things like that if I believe this was going to happen in the short run, because
what are GLDs?
That's a gold ETF. That's a gold fund, if you will, that trades on New York Stock Exchange. What you could do is you can open an account in a country like Canada, which is a separate country, and if you open your account in Canada, you can buy gold and store it in Canada in your bank account in Canada, since they are a different banking system. So nobody would, now I'm getting a little extreme here in the sense of these recommendations, but the point is that would be a way of you not, if the door gets kicked into your home and DHS comes in and says, where's your gold? And you say, well, I don't have any. You can drive to Canada. It's not far, it's 4 hours, or no, it's not 4 days, I'm sorry. You can fly there in 4 hours. Yes, sir.
But you discussed the prospect of the U.S. dollar losing its status as reserve currency.
Without a doubt.
And won't that be the trigger that causes the loss of confidence in it?
That would be one of the, on your way there, you could lose the confidence, because let's say the dollar index now, which is an index of currencies, is about 79. The historical low is, in round numbers, 70, I think 70.4, let me be exact. So if it breaks that number, if you're using what we used to call, what we call technical analysis, you have to go to the low of 1941, which is 46 on this dollar index. So the space between 70 and where it stops the next occasion was the beginning of World War II, and basically it was 41. Now it'll never get to 41, because if it ever breaks 70 and goes into the low 60s, it's going to lose its reserve status. So it's going to be gone well before then. People will be cashing out of the dollar and going into other currencies they respect, such as Swiss franc or Canadian dollar or the Aussie dollar, and there maybe even the krona in Sweden. Of course, there's not a lot of them around, so gold and silver is where most people are going to go, and that's where you get these crazy price increases. Yes, sir.
Do you think Japan is going to be able to create the inflation that Abe is trying to create in the short term?
I don't think so, and the reason I say that is because you can print all the money you want, but people have to borrow it. They have to use it.
It has to have velocity.
Pardon me? And that creates velocity, is right. So the point is, if it's the old expression was pushing on a string, and of course that never really happened in the U.S. till recently, where the Fed is printing all this money, zero interest rates for 6 years, and there's no inflation because nobody's really utilizing the money, because it's much easier to buy IBM than it is to go borrow money. And they're not starting businesses, and see, there's no jobs, and that's why we have a job problem, because you're killing entrepreneurial, if you will, desires to go into business because of the rules, regulations, taxes, right, Obamacare, and you name it.
So we don't have inflation now like we should have, because we don't have any velocity.
True.
Because at 2% interest, there's no lending, so there's no creation of money.
Correct.
So when will that scenario stop? Because it seems like at some point, you see where I'm going?
I do, and it will change when economic conditions present opportunity for people to go and borrow and go into business and make money. So that would imply when Obama gets out of office, and assuming that the administration changes and you get a more, let's say, laissez-faire capitalist president, assuming you do, you get Hillary Clinton, things are not going to change.
So things look great and we all cheer, and suddenly inflation eats us up.
Well, you know, there you now have to go back to the Fed. What are they going to do? Are they going to raise rates quickly and slow down the printing presses and sell some of the bonds they bought? See, there's a variable there. The key is what the variable, you know, how they do it. Yes?
I've heard from the standpoint of government confiscation that you'd be better off buying a numismatic, graded, certified coin in its little plastic case than buying a bullion coin.
Okay, the reason you hear that is when FDR put in his executive order here, he was partial to coin collectors. He actually knew some coin collectors. So he excluded coin collectors from turning in gold coins. So there was he gave a special favor to somebody he liked. He excluded numismatic coins. Now, whether that happens again or not, is assuming there's confiscation, is another problem. But here's the reason why I don't recommend that, even though it did happen once and it was a good outcome for people who had numismatic coins. If you read the Constitution carefully, it basically says that money is, Article 1, Section 8 again, is coin, gold, and silver. This is in Article 1, Section 10 and Article 1, Section 8. Now, that means that it's not taxable. If you buy a gold minted coin, not a bar, not a Cougaran, not a maple leaf, you can't be taxed on that money because it's constitutional money. There was a Supreme Court case, Thompson versus Butler, where they basically, in the, I believe it was in the 90s, it could have been earlier, but they basically ruled that a $50 bill in your pocket and a $50 gold coin are the same thing. Doesn't matter their value, according to the government. So if you buy, now the IRS hates this, they can't change it unless they change the Constitution. So they try to get you on formalities and technicalities. So, I mean, I don't want to be giving tax advice here, but the point is if you buy a minted gold eagle from the government, which there are authorized mint dealers, Dylan Gage is 40 minutes from here. It's a mint dealer. And if you buy it and you make believe you go into Europe and you say, well, I want to exchange $1,000 in paper dollars for $1,000 of euro currency, you're doing an exchange. You're not selling the dollars, right? So these are little technicalities. I'm giving you more information than really should, but the key is you never sell your gold coins. You exchange them for paper, if you want to go back to that. So if you buy gold coins that are minted by the U.S. government, you can't be taxed on them because they're money, and you can't tax money, even though they appreciate. And the Supreme Court has already ruled that a $50 piece of paper and a $50 gold coin are the same, even though the $50 piece of paper might be 1/50th of the gold value. Say that's you can look it up. Thompson versus Bell. Okay, I'm going to ask one more question.
How did the countries that got hyperinflation, how did they overcome it?
Pardon me?
How did countries that finally got hyperinflation, how did they overcome it?
They say, okay, we're taking away this bad currency, and we're going to give you a new one. People, they say, okay, well, it's changed for the short run. That's what they do, by the way. Yes.
When we see this hyperinflation, will we also see a collapse of the banking system?
Without a doubt. Yes, sure you will, because people will run to get their cash. They'll put in capital controls, and yes, no, having money in U.S. banks under this condition, there'll be, before it happens, there'll be capital controls. Where you can't get your money out of banks. It's already happening. You can get so much, and then they want to know what you're getting. This is HSBC, who's in the papers. So, all right, well, anyway, thank you. And you know, I make a pledge to Larry that I'm going to get you 2 members. And if everybody gets 2 members, you'll triple the organization.